Imagine checking your phone at 6 in the morning, half asleep, coffee still brewing, and seeing that silver just jumped more than 5% in a single week. No warning. No big headline the night before. Just a sudden move that makes you sit up in bed and wonder what you missed. That is exactly what happened to thousands of investors recently, and if you have been watching silver at all, you already know the chart has been anything but boring. Silver spent months sliding lower after a spectacular run, dropping well off its highs and leaving a lot of people wondering if the story was finally over. Then, almost out of nowhere, it started climbing again. And that is the real question we need to answer today. Was that recent silver crash actually the end of something, or was it simply the pause before the next move? Stick with me, because there are 3 specific catalysts developing right now that could decide which way this goes, and most investors are only paying attention to one of them. Before we go further, if you find this kind of grounded, no-hype market breakdown useful, take a second to like this video and subscribe to Smart OG John AG. It genuinely helps more people find honest, educational analysis instead of the noise that usually surrounds precious metals investing. Now let's get into what is actually happening. Here is the situation as it stands. After a historic rally that saw silver push to levels many longtime investors had never witnessed in their lifetime, the metal went through a sharp and painful correction. Prices fell hard, month after month, and plenty of newer investors who bought near the top were left staring at red numbers, wondering if they had made a mistake. That is a very human reaction. Nobody enjoys watching an investment lose value shortly after buying it. But here's what most investors never realize. Corrections like this are not unusual after historic rallies. Historically, when any asset moves up quickly and attracts a wave of new buyers, a pullback often follows as short-term traders take profits and momentum cools off. That does not mean the long-term story is broken. It simply means the market needed to breathe. So what changed recently? Silver has been climbing back toward the $60 an ounce level after months of pressure, and the timing lines up almost perfectly with new economic data coming out of the United States. The latest jobs report showed the American economy adding far fewer positions than expected, one of the weakest readings in months. On the surface, that might sound like bad news, and for regular workers concerned about job security, it certainly can be. But in the world of interest rates and monetary policy, weak job growth often sends a very different signal to investors. It suggests the economy may be cooling faster than the Federal Reserve anticipated, and that changes the calculation on whether the Fed needs to keep interest rates high. This is catalyst number 1, and it is arguably the most important piece of the puzzle right now. When the job market shows real signs of slowing down, traders often reduce their bets on future interest rate hikes. Fewer expected hikes, or even the possibility of future cuts, tend to weaken the US dollar and reduce the appeal of holding cash-like assets. And when the dollar weakens, precious metals like silver and gold often become more attractive because it takes fewer dollars to buy the same ounce. That is part of why silver has been finding renewed strength lately, even after such a difficult stretch. Many analysts believe this shift in rate expectations is one of the biggest forces currently supporting the metal. But there is another reason the market may be reacting this way, and it goes far beyond a single jobs report. This brings us to catalyst number 2, the physical supply story that rarely gets the attention it deserves. While most headlines focus on daily price swings, the real signal may be somewhere else entirely, sitting quietly in warehouse inventory data. Industry researchers have pointed to what would be a 6th consecutive year of a global silver supply deficit, meaning the world is simply using more silver than mines are producing. Silver is not just a shiny investment asset sitting in a vault somewhere. It plays a critical role in solar panel manufacturing, electronics, medical devices, and increasingly, the infrastructure behind artificial intelligence and data centers. Every one of those industries needs physical silver to function, and none of them are slowing down anytime soon. Think about that for a moment. Investment demand for silver rises and falls with sentiment, headlines, and interest rate expectations. But industrial demand keeps grinding forward in the background, year after year, regardless of what traders are doing on any given Tuesday. When you combine years of supply shortfalls with steady, non-negotiable industrial usage, you get a market that can absorb a lot of selling pressure before prices truly collapse. That is not a guarantee prices will rise. Markets do not work on guarantees. But it does help explain why silver has repeatedly found buyers even after brutal short-term declines. The market often rewards those who understand this difference between short-term trading noise and long-term structural forces. Let's pause here and think about a retiree named someone very similar to people many of you may know. She is not a professional trader. She spent decades building a retirement account and decided years ago to keep a portion of her savings in physical silver and silver-related investments as a hedge against inflation. When silver dropped sharply from its highs, her account value fell too, and it was uncomfortable to watch. But she did not panic sell. Instead, she reminded herself why she made that decision in the first place, as protection against the slow erosion of purchasing power over time, not as a short-term trading vehicle. That mindset, staying anchored to your original reasoning instead of reacting to every headline, is something experienced investors tend to develop over years of market cycles. It is worth thinking about whether silver is currently up or down in your own portfolio. Now here's the part that changes everything for catalyst number 3, and it might be the one most casual investors are overlooking completely. It involves the Federal Reserve itself, and the language coming directly from its leadership. Recently, Federal Reserve Chair Kevin Warsh acknowledged that inflation expectations appear to be moderating, while still emphasizing the central bank's commitment to price stability. That combination of words matters more than people realize. When a Fed chair signals that inflation pressures may be easing, even while maintaining a cautious tone, markets often interpret that as reduced urgency for aggressive rate hikes. And as we already discussed, expectations around interest rates are one of the single biggest drivers of precious metals prices in the short to medium term. What happens next may surprise you. Based on recent trading data, the probability that the Fed raises rates in September has fallen significantly compared to just weeks earlier. Traders had been pricing in a much higher likelihood of a hike, and that probability has now dropped closer to a coin flip. If economic data continues showing this kind of softness, and if inflation genuinely continues moderating, historically that environment has tended to favor precious metals, because lower rate expectations reduce the opportunity cost of holding an asset like silver that does not pay interest or dividends. If current conditions continue in this direction, some market participants believe silver could see continued support. Of course, economic data can shift quickly, and nothing about future Fed decisions is guaranteed. There's another indicator that could change how you see today's market, and it is one that seasoned commodity traders watch closely: the gold-to-silver ratio. This ratio simply measures how many ounces of silver it takes to equal the value of 1 ounce of gold. When that ratio is historically high, it can suggest silver is relatively undervalued compared to gold, and some investors view that as an opportunity. When it is historically low, it can suggest the opposite. Watching how this ratio behaves in the coming weeks may offer clues about whether money is rotating from gold into silver, which has happened during previous market cycles when investors started favoring silver's higher volatility and industrial exposure. Let's talk honestly about risk for a moment, because balanced education means covering both sides. Silver is significantly more volatile than gold. It has experienced massive rallies throughout history, but it has also gone through long, painful stretches of flat or negative returns. Silver is also more sensitive to global manufacturing trends than gold is, because so much of its demand comes from industrial use. If the global economy slows down sharply, not just cools moderately, but genuinely contracts, industrial demand for silver could weaken, and that would remove one of the pillars currently supporting the bullish case. This is exactly why financial professionals generally recommend that precious metals occupy a modest portion of a diversified portfolio rather than becoming the entire strategy. No one, no analyst, no forecaster, no YouTube channel, including this one, can tell you with certainty where silver will be trading 6 months from now. Later, we'll look at one more market signal that many investors completely overlook, and it has nothing to do with charts or technical analysis at all. It has to do with behavior. Historically, some of the best long-term outcomes in commodity investing have come not from perfectly timing entries and exits, but from investors who established a plan based on their own goals and stuck with it through volatility. That does not mean holding blindly no matter what happens. It means understanding why you invested in something in the first place and revisiting that reasoning during turbulent periods instead of making emotional decisions based on a single red day or a single green day. So let's bring these 3 catalysts together. First, weakening labor market data is shifting expectations around Federal Reserve interest rate policy, and that shift tends to favor precious metals when it points toward fewer hikes or eventual cuts. Second, a persistent structural supply deficit combined with steady industrial demand from solar energy, electronics, and data infrastructure continues to provide a long-term floor of real-world usage beneath the metal, regardless of short-term trading sentiment. Third, the tone coming directly from Federal Reserve leadership regarding moderating inflation expectations is influencing how traders position themselves heading into upcoming policy meetings. None of these 3 forces guarantee a specific price target, and anyone promising you an exact number should be viewed with healthy skepticism. What they do offer is context, a deeper understanding of why the market has been moving the way it has, instead of simply reacting to daily headlines without knowing the story behind them. I'm curious what your own outlook on silver looks like right now. Are you someone who bought during the recent correction? Someone waiting on the sidelines for more clarity? Or someone who has held silver for years and simply rides out these swings without much emotion attached? Drop a comment and let me know which of these 3 catalysts you personally think matters most: the labor market data, the supply and industrial demand story, or the shifting tone from the Federal Reserve. These conversations genuinely help other viewers think through their own strategy, so don't hesitate to share your honest perspective, even if it goes against what I've laid out today. If you found this breakdown helpful, consider sharing it with a friend or family member who has been asking questions about gold, silver, or where the broader economy might be heading. Financial education spreads best when people pass along information that actually help them understand something more clearly, rather than something that just tried to scare them into action. As we wrap up, remember that markets move in cycles, and periods of uncertainty like this one have happened before and will happen again. Staying patient, staying informed, and thinking in terms of years rather than days tends to serve long-term investors far better than chasing every headline. Nothing in this video should be taken as a specific recommendation to buy or sell any asset. Every investment decision should be based on your own research, your own risk tolerance, and your own financial goals, ideally alongside guidance from a qualified financial professional who knows your full situation. Thank you for spending this time with Smart OG, John AG. Keep learning, keep asking questions, and keep making decisions you can stand behind no matter which direction the market moves next.